With that, I will thank and excuse this panel. We have two more panels to go. Mr. Covert, if you would stay with us, you're part of the next panel as well. Yeah, and Mr. Gwaltney, you're also part of the next panel. And I'd like to call up Robert Reich from the President of Community Loans of America.
Well, I don't know that.
Sarah Catrona, General Counsel of Elevate, and James Gutierrez, Chief Executive Officer of INCSID.
All right, we can share microphone. All right.
Yeah. Have a seat wherever you'd like. We have 5 panelists this time. Who is missing? Okay, do we have our 5th panelist?
James Gutierrez.
There he is.
Okay. Again, this panel is limited to 25 minutes. You have 5 people. That comes out to about 5 minutes each based on my math. So self-regulating, we will begin at the top of the list with Mr. Covert.
Thank you, Mr. Chairman. Once again, I'll continue a little bit about what we were talking about. I think what I'd like to focus on is, I'll go to my home state of Tennessee. We have multiple loan products. Take payday lending out of the option. We have multiple other products that my company is licensed to offer, and they can be, some of them are 12-month, 24-month products. And, you know, California has a great regulatory structure for payday. I think a lot of the concerns we continue to talk about is we don't have the options for the longer-term, larger loan. And I think we all agree an installment loan works well for a lot of consumers. And in Tennessee, you talk about 500 complaints. We don't even have 500 complaints in Tennessee because we don't run across those kind of issues. We have other options for customers, and all the products coexist. The longer-term products do a lot of the things we want it to do. You have the smaller amortized payments over time for the larger amounts. Customers are able to get the money that they need without having to take out multiple loans. The larger products solve a lot of the problems. And I'll just say this, Mr. Gutierrez, besides being a snappy dresser, is a good businessman. But so far, that product is doing about, you know, we're 12 times larger on the payday volume than we are on the pilot project. The pilot project is working for some customers, but it's not working for all customers. I still think we're missing some options on longer-term products, and we want to work with the committee because I really think there's an opportunity to solve a lot of the problems with a longer-term installment loan that are out there.
Thank you. Mr. Reich.
Mr. Chairman, members of the committee, thank you so much for the opportunity to be here. I'm president of Community Loans of America, and also I'm president of the Title Lending National Association, the American Association for Responsible Auto Lending. I also was in attendance at the SBREFA hearings in Washington and would be happy as part of my comments here to include comments on that or respond to questions in the question period. In California, we have approximately 160 stores, approximately 400 employees. We are not a minimum wage employer. We provide Blue Cross Blue Shield insurance to our employees. We provide a 401k, and our hiring practices mirror the community we're in, so that if we're in a Latino community, we will hire from within that community. If we're in an African American community, the same. If we're in a rural community, the same. We even have one of our stores in Chicago where they speak Polish. The economic impact of each one of our stores in California puts between $1.5 and $2 million of cash within a very small radius of that store. We are really a local community-based lender. And that money does indeed get spent locally, and that is over and above what we pay to our local landlords, what we pay in terms of taxes and real estate taxes on our properties and everything else. Let me just tell you briefly about who our customers are, because I think it's important to understand where they are coming from. approximately 30% of our customers are small businesses and folks that are self-employed. As an example, a landscaper who will need working capital to be able to finance, hire the work crew for the next job, buy the supplies. He will bring his truck in and use that as collateral for a loan. Our loans are $2,500 and above. We are not a short-term lender. Our loans are between 1 and 3 years. They are fully amortizing loans. There is no renewal kind of process that goes on, so the customer has a very predictable and well-defined expectation for what the payment is due, and month by month sees that loan going down. Second group of folks who come to us are non-homeowners. People who have homeowners, perhaps less now than before 2008, can usually avail themselves of a home equity line of credit. If you do not have a home and you are a renter, your next largest asset is typically your vehicle, and we use that as a means of collateralizing the debt. These loans basically are non-recourse loans, so there is no personal liability involved in these loans. As I said earlier, it's a 12 to 36 per month. 12 to 36 per month, non-recourse kind of loan. And interestingly enough, the single largest reason for default on these installment loans is mechanical breakdown of the collateral. Since these are non-recourse loans, in the event that the collateral is an accident, if it's stolen, if it has other kind of problems like the transmission falling out of it, it is usually a better use of the borrower's money to, instead of fixing that car, to take that $1,000 or $2,000, use it as a down payment on a newer vehicle, and get himself something that is more mechanically sound. The average age of the cars that we finance is in the 8 to 10-year-old range. Okay, so I think that helps explain that. The proposed rules from the CFPB are, in short, devastating. They target loans that are over 36%, that either have electronic account access, which we don't do. We do not take ACH payments on our installment loans. We only accept cash or certified kind of funds or money orders, or loans that have a security interest, which we clearly fall into that range. You should have two handouts that I distributed. One are excerpts from the March 26, 2015 CFPB outline of the proposal before the Small Business Advisory Panel. In terms of that, if you look at the first quote, and this is talking about installment loans, the CFPB admits less clarity as to the impact. That is on page 46, section A, which is a nice way of saying that they don't fully understand it. Tab B, page 47, the likely loan process will require multiple visits, leading to consumers failing to complete the loan transaction. That is on the increased underwriting level.
You've spoken for about 5 minutes now. You're on other people's time, but you can go as long as you wish.
Okay. I will be very, very clear then. But I've listed the discontinuities in terms of their own rules and by their own admission, how this is devastating for the industry. Much of the discussion today has been about agency and lenders, but what about the customers? The question is, who is looking out for them? Certainly not the CFPB, whose throw the baby out with a bathwater proposal, eliminates access to credit for those with no legal alternative. You should also have a CFPB study, which was released yesterday, that headlines 26 million American adults don't borrow money or can't borrow money. That's the CFPB saying this. And the impact of these rules are going to take that 26 million up to new heights. In the title lending installment loan segment, they have failed to show that there is any harm. Haven't released any studies. Our industry association has constantly asked them for that. They are unable to show that there is any harm to the consumer. Do they not have a moral obligation to do so? And what about the 90% of the people, of our customers, our borrowing customers, who derive benefit from these loans? Should not that be a valuable offset to any claim of harm? What of the harm of eliminating their access to credit, which this rule will surely do? In closing, these rules apply to secured vehicles, and other loans over 36%. The impact of these rules is to annihilate this segment of lending. The CFPB claims this is not a rate cap because a rate cap is prohibited under Dodd-Frank. But as my father used to say, if it looks like a duck, acts like a duck, quacks like a duck, chances are it's a duck. So again, thank you very much for the privilege of coming before you. And if you have any questions, I'd be happy to answer them during the question period.
Thank you, Mr. Reach. Appreciate it. We move on to Sarah Catrona.
Thank you, Chairman Block and members of the committee that are here today. I'm Sarah Catrona. I'm General Counsel for Elevate Credit, and we operate in California as an online state licensed lender, Rise Credit. And we support you, the California Department of Business Oversight, Commissioner Owen, and the Consumer Financial Protection Bureau, or CFPB's, efforts to end the cycle of debt and protect consumers from bad actors in the industry and harmful lending practices. Elevate employs rigorous underwriting standards to extend credit and uses ability to repay by various tools in determining the consumer's ability to pay. However, we are concerned that the overly prescriptive guidance as set forth in these guidelines will stifle continued innovation to the consumer's detriment. Rather, we hope that ability to repay standard that is discussed in this document is based on empirically derived data provided by responsible lenders. Lastly, it appears that the CFPB rules, and I think this is very, very important for California and for all states, frankly, that they will trump many of the California laws governing financial services. The issues that arise from federal preemption can be messy and creates much uncertainty in the market, and more importantly, for the consumer. Thank you for the time, and I'll yield to Mr. Gutierrez to finish us off.
Thank you, Mr. Gutierrez, but you're not finishing off. It's
Sorry.
after you.
I skipped somebody. Sorry, Dan.
Mr. Gutierrez, you're
Oh,
next.
I'm sorry. I thought you said Dan was next. So my name is James Gutierrez. I'm an entrepreneur in consumer lending since 2005. I founded a company called Progreso Financiero, now called Opportune, and I ran it for 8 years as CEO, raised all the capital and built a company. Now I'm CEO and founder of a company called InSeek, based in San Francisco. We're a member of the pilot program, and Progreso is a member of the pilot program. I was also on the SBREFA panel last week in Washington as one of the members of the panel. We offer loans from $300 to $2,500 under the pilot program, installment loans, fully amortizing, unsecured, for 6 to 24 months. The typical loan is $1,000. We tell our borrower, if you can make 20 payments of $60 every 2 weeks when you get your paycheck, you pay us back $1,200. We give you $1,000, your cost is $200. Our average FICO of a borrower is 570. 50% of our borrowers don't have any FICO score or have a very thin credit file, and a very high percent are underbanked. So basically, these are borrowers that would never be able to get a loan from a traditional bank or credit union. So speaking about CFPB rules, most of our loans would be covered under the CFPB rules for 2 reasons. One, some of our loans would have an all-in APR above 36% as provided by the pilot program. And also, we would have an ACH as a method of repayment for some of the loans, and therefore they would fall into the CFPB rules. We believe that we'll be able to comply with the CFPB rules as they're currently documented. Now, I do want to make one qualification. We're not a typical small business. We've raised $26 million of venture capital for this company, and in Progreso, we raised well over $150 million during my tenure. And so, we're trying to build a system that's like a large credit card operation that's fully automated, centralized. But so in that way, we are able to comply, but because of the investments we've made. For example, in this company, already $2 million has gone into our engineering and product team. A couple of things about the CFPB rules, and I want to be very specific. So we do full income underwriting, so all of the provisions on ability to repay ATR around verification of income, we already do that, so we feel like we can comply with that. We've built a way of uploading documents into the cloud and having a back office look at them and automating that process, so it's not, although it's like mortgage type underwriting, we can make it fast so that it works in a convenient environment for customers. We spent a lot of time working on that. Specifically, we would like certain changes to be made to the CFPB proposals for it to work better for us. So on the ability to repay, expenses, the CFPB presumes that we can verify people's expenses. You can't. Expenses are only self-reported, and it's unrealistic to expect, for example, if someone gives you a lease agreement to verify their rent. Today, when we ask people for proof of address, only 1% of people submit a lease agreement to prove their address. When you're lending to the underbanked, there's a lot of 2 or 3 households living under the same house, so there is no lease agreement. It's an informal arrangement. So we recommended last week that the CFPB not require any sort of verification of all their expenses from housing, auto, leases, bank statements, child support. All of these things we felt are unreliable, except if there's an expense that's in the credit bureau. If it's in the credit bureau, you can verify it. So if there's other financial obligations that are reported, we're okay with that. But that was something that we care deeply about. The second is that the CFPB presumes that you can do periodic. So if you make a loan for 10 months, I need to make sure that you meet the ATR requirement for all of that life of that 10 months. When I get a snapshot from the credit bureau, I only know today. I don't know what that's going to look like over the next 10 months. So we told them last week that's very unrealistic. Provided they clear up those 2 sides of it, we feel like we can comply with ATR. And in general, we're a big believer in ability to repay. We like what the language, we actually recommended last week that the CFPB consider the pilot program language around ability to repay, because we think it's actually better than what they suggested. Last thing, they suggested 2 alternative options if you don't meet the ATR, which we do, which is option 2 and option 3 that they've stipulated in their proposals. We told them last week neither of those work. Option 2 is, loans are only up to 6 months, so it's too short, and only 1,000 too small. But just to give you the economics, if we did one of those loans under their proposals, a $1,000 loan, 6 months would get $97 of revenue, 77 of that was interest, $20 of fee, with an 8% loss rate. So we target a 5 to 10% loss rate, and what we do at an 8% loss rate, that's already $80 off the 97 of revenue. So you basically have $17 left to cover all your other costs. It just doesn't work. Finally, on option 3,
Actually, we're going to, Mr. Gwaltney, if you need 5 minutes, it's up to you. Okay, go ahead.
Okay, sorry, thank you. So that doesn't work. On option 3, it doesn't work because they're saying, and there's been a lot of discussion with the Pew Trust Institute about a 5%, of your gross income is your payment to income ratio. That doesn't make sense. If we did that today, 32% of the borrowers we've already approved would not pass. And those are loans we've already approved. So what we suggested last week is if they made that around 12%, that would be an alternative that could work. We actually suggest other forms of cutoffs that are not their definition. So we like one that is similar to what was used in the pilot program, which is more sort of a debt-to-income payment to income of 50%. We think that that's better, and that's what we recommended last week, and we can submit that in our written commentary. I will end to just say 2 things. The trend is that with the Credit Card Act, the Dodd-Frank, and all the other Basel II, Basel III, banks cannot lend. They're actually penalized. They have to hold a high percentage of risk-weighted assets from their capital requirements if they lend to people with low FICOs. So it means that banks are not going to provide these loans. When you think of access to capital, it's slim if you fall into some of these buckets and you have low FICO score. That's a problem. The second part is this new...
Mr. Gwaltney, you have 2 minutes left.
I'll hand it to you. I'm finishing. Thank you very much.
Thank you, Mr. Chairman. I just want to follow up with some of the other comments that were made, and I'll just point out briefly, because our time is limited, that our members in our trade association do have concerns about the long-term proposals by the Bureau. California law already has a lot of protections that they pointed out in other states that they're concerned about, and that's one of their justifications for the long-term proposals. California consumer finance law does not allow what they see in other states is small dollar payments then followed by a giant balloon payment. We don't do that here in the state of California. And they're concerned about negatively amortizing loans under the California finance law. Lenders are not doing that here in the state of California. So once again, I think that the Bureau has not had a chance to go back and look and do their analysis of each state and make sure that they're not doing a one-size-fits-all. I would also second something that Ms. Gutierrez said that came out. It came up during the hearings back in Washington, D.C., that the two different models that they propose to be alternatives just won't work. And we've done the analysis on those, and we would agree that those aren't alternatives. The other thing we haven't talked about yet, there's a couple other small proposals that they're suggesting having to do with ACH and collection payments. We feel that the Bureau didn't have a chance to really look at what's going on in the marketplace, in that the governing body that controls ACH is the NACHA organization, has released rules, and those rules have nothing to do, they're not in the proposal. So I think that's going to solve the problem that they're looking, and we asked the Bureau to go back and look at those rules. I know I'm out of time, so thank you very much, Mr. Chairman.
Thank you, Mr. Gualdi, and please stay where you are. This panel, we do have an additional panelist who is on the same time as this panel. We'll have 5 minutes, but represents a slightly different perspective from the traditional industry perspective, and that's the tribal perspective. Chairwoman Treppa from the Habbamtal tribe, we'll bring a chair up for you. Would you join us at this table?
Right here. Right here's fine.
Thank you.
No, we're good. Okay. Thank you, Sergeant. Yeah, you'll have 5 minutes to give us now the tribal perspective on the CFPB proposals.
Great. Thank you very much. Thank you, Chairman. Thank you, members of the committee and Assemblymember DeBobne, for providing this opportunity to address the committee on this very important issue. My name is Sherry Treppa. I am the chairperson of Habbamtal, Pomo of Upper Lake. We are a federally recognized tribe that resides in the county of Lake. Since 2012, our tribe has owned, operated, and in our capacity as a sovereign nation, self-regulated an online lending enterprise that offers small dollar installment loans. In addition, I have the privilege of serving as the vice chairperson of Native American Financial Services Association, NAFSA. It is an intertribal organization formed in 2012 to assist its members in offering responsible online lending products through established best practices. In my comments today, I will not address the applicability of the CFPB's draft rules on small dollar lending. As many of you know, the question of the CFPB's jurisdiction over tribal businesses is currently being considered in the Ninth Circuit Court of Appeals. And for today, I will leave the issue of applicability to courts. That said, I believe, given my unique and significant experience within this industry, my analysis of the net social and economic benefits of the products targeted by the CFPB's draft rules is both practical and uniquely relevant to today's discussion. As many of you know, Native American communities nationally face poverty at a rate that is nearly double that of the general population. While gaming did create new and prosperous reality for a select group of urban tribes, the reality is that most rural tribes suffer from almost institutionalized hardships that includes a lack of educational and economic opportunities. An epidemic of poor physical health, including significant obesity and heart disease, and maybe most appalling, unspeakably high youth and adult suicide rates. Sadly, my own tribe is all too familiar with these struggles. In the 1950s, the federal government terminated our federal recognition. It wasn't until 1983 that our recognition was restored, and again, another 30 years until we secured any significant economic opportunity in the form of a gaming enterprise for the benefit of our people. Sadly, the financial projections for our gaming venture haven't proven true, And while our casino provides employment opportunities for our members as well as the local community, it is mired in debt and unlikely to generate meaningful profits for years to come. My tribe, like many other rural tribes, have established, own, operate, and self-regulate online tribal lending enterprises. Such businesses are governed by tribal law, voluntarily comply with all applicable federal laws, and enforcement activities are conducted by individuals, tribal regulatory agencies. This role as a regulator is not new to our tribes or others. As sovereign governments, tribes have significant regulatory experience, including gaming, natural resources, and now financial services. Operating an online lending business has provided my tribe and other NAFSA member tribes significant benefits, including expanded tribal government revenues and living wage employment opportunities for our citizens. Proceeds from the enterprises represent more than 70% of most of our NAFSA member tribes' annual budgets. In my case, it is 100% of our non-grant-funded budget, and substantially improve the quality of life for tribal members. For example, these proceeds are used to fund education programs, including college and graduate scholarships, job training, and employment programs, and have enabled my tribe to reclaim, through recent purchase, small pieces of our former homeland, including our ancestral cemetery. Our tribe continues to strive for self-determination and self-sufficiency, and we create programs to encourage our citizens to do the same. Should the CFPB's proposed rules become final and it's determined that they apply to our businesses, much and possibly all of our recent progress as a nation would be undone. But the questions of the CFPB's rules and their impacts is bigger than just the health of a tribal economy. This question is about This question is about the consumer and the credit solutions they can access, as many of our colleagues have enumerated earlier. As an elected official, I can understand the Bureau's desire to protect consumers, but I believe a common sense examination of these draft rules proves that they are over-restrictive and will have the effect of choking off a vital source of access to credit for consumers who need it the most. The Bureau's proposal does not take into account the fact that my tribe's business entities and other tribal entities already utilize sophisticated underwriting software, allowing for varying payment methods to maximize consumer and performing exhaustive fraud checks. For the Bureau to simply assume that all tribal lending businesses do not take into account consumers' ability to repay is simply not accurate.
And
moreover,
you could wrap up in about a minute, Chairwoman.
Thank you. Moreover, the verification requirements set forth in the Bureau's proposal do not address the issue, as the information sought is often available or is too burdensome for consumers to supply. I will close by reiterating that these programs have been good for my tribe and that we are proud to operate a business that empowers consumers and provides them the option as they address their individual financial needs.
Well, thank you all. I know it's hard to get everything into 25 minutes for a group like this. And Mr. Risch, thank you for the documents you've given us. We will take those into consideration.